But let me talk about something that may come into as you get out into the pharmacy world, and you're maybe want to open your own pharmacy, and you need to get a loan for maybe a real estate loan or whatever. There's a regulation called Regulation B, which is why I had to ask that question: who's applying for credit? And Regulation B is an equal credit opportunity rule, and it was done primarily because generally speaking, the wives didn't know what their husbands were doing in business, and they were asking their wives to co-sign and sign all these note documents, and they didn't know what they were, but the bank was requiring them to sign it anyway to get the loan. So Regulation B says that a bank cannot require a spouse to guarantee a loan or to sign jointly as a condition of getting a loan. So that's to protect the spouse there. But then the bank has asked the question: are you credit worthy in your own right? I mean, do you have enough assets and enough collateral that we're comfortable in making you the loan in your own capacity, or do you need a co-signer? Now, generally speaking, houses are held jointly by the husband and wife. Cars are in both husband and wife's name. I mean, if you ask me to fill out a financial statement of just what I own, there wouldn't be very much on it, because everything I own is jointly with my wife. So I couldn't get a loan because I don't own anything. Now, if the bank was doing their job, they would say, well, do you know anyone that might co-sign this loan? And they say, well, maybe would my spouse work? Then the bank would say, yeah, that would be good because everything you have joint and you have assets jointly. So, but it is a protection there, and we have to comply with that.
Are student loans just like any other loans when you're looking at your credit score? For example, say person A, person B has a CMI loan, it's $120,000 school loan versus $120,000 home loan. Is that looked at the same way?
On the credit score, I couldn't guarantee that. I just don't know.
Standard, like, how would you look at that?
I think either one of them, if you're delinquent, is going to be a big negative.
But
so
the amount itself, just having it itself, is not like
no,
average banks.
no. The biggest thing you can do for your credit score is don't be late on your payments. And we do not report to the Bureau anything under 30 days past due. So you can be 20 days past due, and we may charge you a late fee for that, but that doesn't go to the Bureau. So you got to keep it under 30 days past due. Never let your payment get more than 30 days past due, ever. And you'll have a pretty good credit score if you do that. It's the most important thing. I wanted to, there's a handout here, and I wanted to go over this with you because I think this is, and then I think I'd be finished. I can talk about some other things if you want to, but this is something I think it's good for, something you can take with you maybe and as a reminder on how you should manage your credit. And I just did an example, and this is a hypothetical. You've got a pharmacist and married to a state employee, okay? So look on the top left-hand side there, and you'll see this is the end. What I did here is I scheduled what is your income? Because if you come to me for a loan, I'm saying, how much money do you make? What's your income? So I got a salary of $5,000 a month for a hypothetical pharmacist making $60,000 a year, and the spouse working for the state making $28,800 a year, so that's $2,400 a month. So they're pulling down $7,400 a month in income. So I put a little note over there. The $1,850 represents 25% of total income. And that would be enough to amortize a $325,000 mortgage at 5.5%. 5.5% is pretty close to the mortgage rates right now. So you could theoretically borrow almost $300,000, around $300,000 on a mortgage, and still be at 25% of your gross income. Let me point you first before we go any further. Down in the lower left-hand corner there, I put down some rules of thumb for debt service. And that rule of thumb is that the housing debt should not exceed 25% of total income. So that's and so what I've done up here is calculate that for you to say what that would be. That's a rule of thumb. That's the maximum it should be. Now some people will go a little higher than that, but in my opinion, you shouldn't go any higher than that. I think that's you're starting to be what we call house poor. You're putting all your money into your house payment. The other rule of thumb down there is your total debt. That includes your student loans, your boat, your car, everything else that you borrow money on, the total debt should not exceed 40% of your total income. Say your total debt payments, how much you pay each month, should not exceed 40% of your net take-home, of your gross take-home pay. Now let's go back up to the top there. So we know that this couple makes $7,400 a month. So I just made up some loans down there, and this, I'm assuming that each of them has a car, and I assumed that they had, $25,862 car loan. That's about what a Camry, a mid-sized car, a Camry, or maybe a little bit upscale Camry, loaded Camry, or something might cost. But assume both of them work and they need 2 cars to get back and forth. So I got 2 car loans there for $25,000 each, and that's going to cost them. They're going to have to pay $500 a month to amortize those loans at 6% over 60 months. And I put over there, just to the right of that, if they had a $10,000 car loan, they'd only have to pay $200 a month, which that'll come in play here in just a minute. But this couple likes boats, and they like to hang out at the Lake of the Ozarks, Tantera, and put their boat in place. So they went out and bought them a $40,000 boat. The banks don't like boat loans very much because there's a high rate of default on those. So we charged them 9% for this boat loan, and they're amortizing out over 72 months. And so when you amortize it over 72 months, it takes $721 a month. Now, I didn't count in here any of the expenses associated with that boat, the gasoline you got to get, the docking fees, and all the other expenses related to the boat. I just put the payment in there. And they got a home loan. In this case, I assumed, just for argument purpose, that they went out, fell in love with this big old house and bought it for $440,000, and at 5.5%, they were paying $2,500 a month on a mortgage there, and that's 33.7% of their income. And I also assumed, and you could put student loan debt in there if you wanted to. I assumed that because they've been spending more than they've been making, they had to run up credit card debts of $20,000. And so I said, okay, if you paid that off over 5 years at 12% interest, it takes $445 a month to pay off that $20,000 credit card debt. But you could plug your student loan in there and figure out what that was and substitute that for that. So if you add up your total debt service, it's $4,666, and I penciled in on the right side there, that's 63.1% of their total income. That's a lot, isn't it? I mean, that's really high, because down below I said it shouldn't be more than 40%. And they're paying 63%. Look on the far right-hand side there. I just took what their total debt. Their total debt's $552,000. That's a lot of debt. That's over $500,000. And their debt's 6.2 times their gross income. So that's a lot. So I said, okay, I'm going to take them into counseling and counsel them on how to get themselves out of trouble here. So I took them into counseling, and I said, okay, we're going to reduce their debt. I said, first of all, you don't need 2 $25,000 cars. Let's have one car, a $10,000 car, and have one nice car. But, let's buy a used car. They're pretty cheap right now. That's going to save them $300 a month. Because up above there, I calculated $10,000 is only $200 a month. They're paying $5. So I'm saving $300 a month for that. I said, get rid of the boat. These people can't afford a boat. Get rid of it. And that's going to free up a lot of other expenses for them too. But maybe someday when they save some money, they can afford that boat. But right now, they need to get rid of the boat. That saves them $720 a month. And I said, that $440,000 house is too expensive. Let's sell it, move down a little bit. Let's have a that's a nice house, $264,000 in Jefferson City, Missouri. You can get a real nice house for that amount of money. That's going to save them $1,000 a month by buying a cheaper house. Then I said they're not going to be able to do this right away, but if they follow this plan over 6 months to a year, they're going to pay off all those credit card debts. And so that's going to save them that $445 that they're paying on credit card debts. We're going to get rid of that. It'll take them a while to get that paid off, but if they save and be a little frugal for a while, they'll get that $20,000 paid off. So that's going to save them $2,465 in total payments. This couple's still going to have a $264,000 home, 2 cars. One costs $25,000, the other one costs $10,000, and they're still going to be living pretty good. there, but that, I'm gonna save them